company? Yeah, is it a strong company? Do they have some things that they need to report and go well? Yes, right? The money that they're spending on AI, people want to know, where is it coming from? How are they getting it? And is it going to be worth it? So they'll have to have some good earnings in that sense. The cloud business, though, I think is still something that is legit. I think that's definitely a revenue metric that has to be taken into account. I think it's pulled back to a point where if people are looking, and I know they were like, oh my gosh, we missed this run up, isn't it an opportune time? For me, it's looking like an opportune time to be in a leap. I called him about it. I can get to show him the one I'm looking at, and I'll probably put in EYLU probably tomorrow morning. But I'm looking at it because I'm saying, has it depreciated? Yes. Are we still in some of those calls that are down? I think one of them is like down 27%, 30%. Yes. Is it a strong company that has a definite role in the future of the sector that is going to grow? Yes, AI, I believe, is a sector. Yes, I believe Oracle will play a role. Obviously, their partnership with OpenAI. Obviously, what we talked about in terms of Stargate. But they also have ties to other things as well, and we'll get into those. What's your going? So this is a company that I'm looking at. That would be a leap that I'm looking at definitely for this week. Obviously, I don't like to do leaps on the day of their earnings, but this is a unique case where I'm like, this has fallen so far that there might be some upside here.
For me, on a pure swing trading basis, not option related, if Meta gets back to 614 to 600 flat, I really love it. I don't know. I think it's incredibly underpriced. I think fair value for Meta now should be 715. Before the fall, I had the price in stock club, I think 30 days or 25 days prior. So everyone kind of knew where to start to load the boat up at or get in the swing. But if it gets from $612 to $600 flat, I like Meta for the long-term hold. By Q2 of next year, I think Meta should be back at 750, 851.
Love Meta.
Yeah.
Love Meta.
Yeah, we got into a Meta trade when it dropped that, I think it was like 3 weeks ago. It had a very large drop. And then it dropped actually consecutive days. And Dave Shands got him in that trade also. So,
the same one?
Yeah. But Meta, yeah, definitely with Meta, because we've seen this happen before. Remember this? This happened. Meta had the largest, at that time, it was the largest stock drop in history. And then it rebounded, and this has happened a few times in Meta's history where the stock has dropped pretty drastically, but definitely got to be bullish on Meta long term. So whenever that happens,
take advantage.
You got to take advantage of it. You definitely got to take it. Somebody asked what are leaps. Leaps are like options contracts that go out 6 months and beyond. I like to do mine at least a year. So somebody's looking at like, what am I looking at? I'm looking into January of 27 right now. Somewhere probably in the money or at the money. So if it's trading at 222 or so I might be looking at a 230 or 225. It's just a little game if you needed to know.
And Meta spending has been more under control and going to better assets, so it doesn't make sense why. Like, my criticism of it in 22 was the spending on the metaverse, I think, was ill-timed and it wouldn't pay out. They've probably deployed, and the return on that capital will be the highest probably in about 3 or 4 years. I have no clue why most analysts downgraded them that much or shorted the stock that much. I think it's absolutely asinine.
The crazy part is that they didn't even downgrade the stock. It just investors started to sell off.
Yeah.
I like the mindset that he has. I just think I agree with it in the sense where he's like, look, if we overspend, okay, what we can't afford to do is underspend and let...
Because the price is going to, once again, inflation creep. When the new chips come out, you would have killed them for that spend next year. So to front run and to deploy the capital at the right time, it's like, I don't understand it. But
yeah, get ahead of it, man.
Yeah.
Well, once again, going back on Meta, saying like, what we've seen this movie play out before. Another movie that we saw play out before was Bitcoin. So Bitcoin has been hovering around 90,000 for about a week now. Dropped and rebounded. So is Bitcoin headed for 65,000 or 70,000? Or is this just an emotional driven speculation? I saw Tom Lee saying that by the end of 2026 is going to be at an all-time high again.
At the end of 26?
At the end of 2026.
Okay.
That's what Tom Lee said.
Okay. Cool.
So, yeah, Bitcoin.
Simple. If it falls to 60, buy. If it falls to 70, buy. Hold for the long term. Do I think we'll get there this year? No. If we get there next year, it's a great price to buy. If we slide back into the 80,000, I think we can, worst case scenario, get back to like 80,000, 81,750. Those are all buy zones. 60, you have to love it. You have to love it. Once again, everything that could go wrong, you have to front load into your research. What are the 3 prices you would want to buy an asset if it absolutely fell apart based on different ranges? And 81 and 60 are great, but it doesn't do you a great job to worry about it. I think you should definitely deploy more money at the 60 and 70 range if it happens. But if you're holding for the long term, none of those concerns should matter. But I definitely think, just looking from a pure technical standpoint, anybody who's buying in the 120s or 115, you're getting in too late. You're getting in too late. So if you're concerned, wait till 81 and some change. But could it go to 60? Worst case scenario, yes. But that would probably be the best buying opportunity in Bitcoin since it got to 20,000.
Yeah. And then also another thing I saw online was, the conspiracy theory of that quantum computing is going to lead to the end of Bitcoin because it's going to get so advanced that it's going to be able to hack any wallet. And they rolled out a whole doomsday scenario of
I saw that.
Satoshi's wallet being hacked. And once Satoshi's wallet got hacked, then that just led to complete, fear and selling of Bitcoin, and to the point where it just dropped to zero. So the thing about that is that Bitcoin actually is not something that doesn't evolve over the course of time. So the technology is evolving. And the quantum computing hacking situation, I mean, if that's the case, then anything quantum computing hack.
Could hack.
Yeah, including your bank account. Including your brokerage account, including your Coinbase account, including government, everything. Mm-hmm. So yeah, but that's not the only technology that's advancing. So as that, it's like anything in life. As the bad guys increase their muscle, then the good guys have to increase their muscle as well. So
or they go hire the bad guys to figure out how to encrypt it.
Yeah. So cybersecurity is definitely going to improve over the course of time. But that doomsday scenario of Bitcoin, like I said, Bitcoin is not something that does not evolve. It does evolve over the course of time, and technology is open source. But also, that's not the only thing to worry about. If that's the doomsday scenario, then everything on Earth is going to fall victim to a hack of quantum computing.
I agree. That's been floating around for a couple of years. I don't think we have to worry about that. And like I said, they'll Langley pay whoever they need to encrypt what's over there. That won't drive it to zero. Even old boy's involvement with the little play, that won't drive it to zero.
We should call our friends at CrowdStrike.
All right. Well, let's bring our guest on. We have our guest, Caleb Silver.
Friend of the show. Caleb, what's good, my guy?
My brother, how are you?
Nice
merch.
Y'all
twinning.
Caleb, what's up, man?
Good merch.
Hey, Caleb.
Good merch.
Quickly, tell them what happens every time you wear that sweatshirt, man.
I get so many phone numbers dropped on me. I got people DMing me left and right. I can't walk around with my family. It's embarrassing. Not only do I look fly fresh to death, it's warm. You guys got a good sale going on right now. And it is probably the most important metric in the stock market right now. Assets over liabilities, right? Gross profit margins, revenue per employee. That's what's driving a lot of these stocks right now. So your logo is perfect. And this is the perfect hoodie for the cold winters of New York City.
Yes,
I appreciate you. One of my favorite people on the planet.
Absolutely.
Yes,
and I tell my friends not to kidnap you in Atlanta anymore.
Yeah, that's okay. That ended up being one of the greatest nights of my life. Shout out to my guys in Indy right now. I know they're tapped in to Market Mondays as usual. Good to be with you as always, my friends.
Yeah. All right. So Caleb Silver, editor-in-chief of Investopedia, and just all around very intelligent person when it comes to stocks, and has been a great resource and friend to the program and everything that we've done from InvestFest to Market Mondays to Earn Your Leisure. So always appreciate when you come on and share your wisdom. You've done technical analysis when it comes to cryptocurrency. You've done all types of different stuff. So I want to start the conversation with Netflix. So we talked about this on Instagram a few days ago, where at the time it appeared that they acquired Warner Brothers and all streaming assets for in a $72 billion deal. And that was something that really just broke the internet. But then a few days later, the Trump administration raised concern about Netflix purchase of Warner Brothers and said that not so fast, as far as raised the concerns about it being a monopoly. So, okay, let's have a whole conversation about this. But first, let's talk about from an educational standpoint, and this goes to the website for people that may not know, what is a monopoly, right? Where does the antitrust and the government come into play at some point in time. I believe, this is like to stop all of the Carnegie and Rockefellers things that happened in the early turn of the century.
Right.
So talk about monopolies and how this all comes into where we get here now.
Yeah, this is beautiful. This is the entire sort of history of American capitalism all coming to an head over entertainment assets, the biggest ones being obviously the Warner Brothers library and Netflix, which would have become the biggest content company in the world, basically. So monopoly goes all the way back to the antitrust acts of the Railroad Acts, the Sherman Act of the Railroad Acts in the 19th century, late 19th century, when the railroads were developing in this country. They were building out, trying to get cross country, and there were several big ones that were colluding together, and that defines a monopoly when you have two or more parties colluding together to try to corner a market and control market share. That is deemed monopolistic when they make it anti-competitive for competitors to enter the market and anti-competitive for suppliers potentially to supply to those competitors. That's monopoly. And usually the Federal Trade Commission rules against monopolies and have tried to strike them down, except when the price is right. And we saw today, or it was today or yesterday, a beautiful hostile takeover bid from a competitor now entering the market. So you have a monopoly, potentially, you have an antitrust ruling, and now you have a hostile takeover bid, all wrapped into one story. This is Investopedia wrapped up in a beautiful box with a bow. I love it.
But doesn't this make it a little bit more interesting that the administration is involved in this? Obviously, they said that they don't want it to be a monopoly, and then today the president said that he doesn't have friends on either side. But a little dig into the research, he doesn't have friends, but he definitely has family on one side.
Vested interest, yeah.
He definitely has a vested interest. This is pretty unique, no?
Yeah, it's pretty unique, but it's not unusual to this administration. The last time I was on here with you guys a few months back, after this administration took office, I said the most important metric right now for companies is proximity to power. Who is sitting at the White House? Who's having dinner? Who's being invited to the CEO private dinners and Mar-a-Lago for golf and drinks by the pool? And if you're in that camp, you've done very well as a stock. And this administration has proved that it is going to do what's in its best interest and the best interest of the people that are close to it, and also put their hand into private businesses, whether that's investments in companies like Intel, or whether that's trying to strong arm deals between NVIDIA and its suppliers, or AMD and its suppliers, or guarantee that companies build factories and infrastructure here in the United States. They're going to do it. So assume that they will have their hands in this as well.
Ultimately, who do you think ends up winning the bid to acquire the assets?
The highest bidder, and the highest bidder will definitely have to fill a few pockets along the way. And that's just the way it goes. And it's not like it's that unusual for this administration, just a little bit more blatant. This has been going on for years and years and centuries in this country. That is really the history of American capitalism. And if you need any proof of that, Andrew Ross Sorkin's terrific book, 1929, really tells that story pretty well. Things are not that different, guys, almost 100 years later than they were. And we're in kind of a gilded age right now, too.
So is this a thing with it? They saying, okay, this is going to be the biggest deal ever when it comes to, the entertainment deal, and I'm not involved in it. As far as Trump, let's slow this thing down, because you can't make these types of deals if you don't check in with Jefe, right? Like that's disrespectful. It's like Narcos. You can't go on my turf and not at least include the family in the situation.
Yeah, but he did.
Did they?
Yeah, American Gangster, right? Don't don't cross the bridge without our permission.
So Ted Sarandos, the CEO of Netflix, sat down with him, and he thought that they were on the same page.
Sit down. I'm talking.
Which is why he didn't
open the trunk.
What's the deal structure? Yeah.
So that's what makes it very interesting, is that he actually sat down with him before they announced the deal with Netflix, the Warner Brothers deal, and he thought that they were on the same page, which is why he came out Friday and said, we're doing this deal. Obviously, we saw, David Ellison had a different standpoint on that because he's saying, look, not only did we offer more, Netflix deal was for $72 billion. They said they offered $108 billion. So they offered more money and they offered more per share. So they were going to pay him $30 per share.
Yep.
The Netflix deal was at 26 and a half. So there was more money involved. They said they were going to protect Hollywood. So David Ellison saying, like, this is the CEO of Skydance Paramount. What happened? Right? It makes it pretty unique, which is why when you look into it deeper, so like that's the part is like, okay, well, why is he coming on saying this? And it goes back to when we talked about the wealthiest people in the world and what do they all want to control? And that's media, right? And we've seen it. And the only thing that Larry Ellison, who is the father of David Ellison, doesn't have at his leisure is media, right? They had Skydance, they got Paramount. If they were able to acquire this, now he has a full conglomerate. What makes it even more...
He's got CBS.
and you got CBS, right?
Yeah.
But CBS is a debt. It's a huge debt. It doesn't make any money. Paramount doesn't make money. So the thing about it is now, how do they fund this? How are they going to get 108 billion? And that's the real tricky part, because in order to get the 108 billion, they have to raise it. And so you start looking about where they're getting money, right? If you look at the list, you got the Saudis, you get Abu Dhabi's involved,
Jared Kushner,
and so that's where the buck stops with me, right? So when you start looking, Tencent, Infinity Ventures, whose president is Jared Kushner. Now this deal, as soon as that deal goes through, here comes the Ellison Group. Wait, this is not what we agreed to. We had a better offer. Now, what does it even mean to have a hostile takeover? This is language that is like, okay, we know what that means in war. What does this mean in business?
It means breaking into a deal with a higher share price offer that makes shareholders who have a responsibility, and the executives and the board of directors have to consider it very seriously. They have a fiduciary duty as the board of directors to do what's best by their shareholders. So if somebody comes in with a higher offer, even though you might have a deal in place, even though you might have a $5 billion breakup fee, which I believe this one has, they have to consider the offer. If they don't, they could be sued if Warner takes that other offer. If they take a lower offer, they can actually be sued for that. And that could end up costing them hundreds of millions of dollars down the road. So they're weighing these different probabilities out, saying, well, is this likely to be approved anyway? Can we raise the money? And if the money that we can raise, is that going to be approved by this administration? Is everybody on the same page here? It's like The Wire. You think it's one way and it isn't. It's the other way. And that changes real fast when a higher share offer comes into play in the form of a hostile takeover.
And then, Ian, before, just follow up, because somebody put it in chat, and shout out to them. Jamar Parkinson, Barbarians at the Gate, a great movie to watch. Anybody that's interested in the stock market, because this is like on a very, very high level, but on a small level, this happens all the time. So corporate takeover artists, that was in the 90s when they made that movie about investors taking over companies strategically. You buy enough stock, then you go to the workers of the company that have equity, and you get their stock. Either swindle them out of their stock, or you just buy it, and then you go to the board, and then you talk to the board, and you make deals with the board. And then before you know it, the board switches on the actual CEO. It's like
the icons move.
It's like a coup d'état in business. And
absolutely,
some people say Elon Musk. When you really look at it, that Barbarians at the Gate was actually a great book. The movie was based on the great book, I believe, by Bill Burr, and it really tells the story of RJR Nabisco at the time. That was the biggest hostile takeover in history, and that was a bunch of private equity investors coming in for the assets of RJR Nabisco, breaking up that big snack giant and the tobacco company at the time. But this is not that different, except the numbers are even bigger. And what's at stake when you think about media and control of media, and what this would actually put in Netflix pockets, or in the case of the Ellison family, what it would put in Skydance's pockets, is one of the biggest film libraries of all time, plus the access to other things. And in Netflix's case, what do they want? What are they trying to corner right now? Entertainment, which they're pretty close with, and sports. They're getting more deeper into live sports. So if they have both those assets, they become the must streaming service. And that could be anti-competitive. It is anti-competitive, but there's a lot of anti-competitive behavior out there that just gets allowed because the dollars are right.
I was just going to say, just a follow-up to it. In between all of this, right, as we're watching this news, are Netflix investors, right? Because when you watch a stock and the company says they're going to spend $72 billion, obviously we've seen the stock just go down lower and lower. How should investors of Netflix be looking at this situation?
Yeah, I mean, there's two outcomes here. Either Netflix is approved to do the deal, and it's going to take a hit because it's going to cost it a ton of debt. And that debt, even on the back of a company like Netflix, which is very profitable and been growing very nicely, that weighs over time. So all of a sudden, it doesn't become the growth company that it was. And it's really amazing that it still is a growth company. It keeps growing subscribers and adding $1 every year to every subscription. It's a beautiful business. So you got to be concerned about that, or it falls apart and Netflix is Netflix plus the $5 billion breakup fee that it has to swallow. So not a great situation either way. Now, over time, if the deal is approved, it could end up being a great, and one of the great deals of all time, but it's going to take a long time to get that share price back to cruising altitude, just given the heaviness of the debt. So it put itself in a weird position. It might win, the overall war, but lose some battles along the way in terms of share price. That said, its shareholders are super loyal. It's one of the top 10 best performing stocks of the past 20 years.
If Netflix isn't doing the consumer any harm, and I know Jared said that there would still be movies by Warner, he would make sure that the consumers are taken care of, the creators are taken care of. But if we're clear, I think the assets will have a better house with Netflix. Is a monopoly a bad thing if you're taking care of your investor class, consumer class, and the creatives in which you're acquiring?
Yeah, the last part's the tricky part, the creatives and the suppliers of the content.
Yeah.
Right. We are, not far out from that big strike over a year ago that really brought Hollywood to its knees, but it was really a reckoning of saying this business has changed forever, right? It's never going back to the way it was. So in a way, this is a way to control that race to the bottom. But if it's at the expense of creators, if it's at the expense of the entertainment industry, and producers and studios trying to get content out there, that becomes anti-competitive at some point in time. Now, you can say you're going to take care of your people, but who are your people at the end of the day? And if you continue to raise your fees because you're the dominant streaming service, and squeeze other competitors out, that is a monopoly. No two ways about it. Not saying it won't be approved, but it will be an operating monopoly. And we have a few of them that are already out there.
Yeah.
So, yeah, I mean, it's interesting from a standpoint of hostile takeover, because even talk about Netflix, and that's what they said. He came with the baseball bat. Shout out to
hostile takeover.
Shout out to Lou. He said you're gonna have to come with a little bit more than a baseball bat for 25.
That was a great
That's it. Yeah, for sure.
That was a great take.
But Kirk wasn't built like that.
Nah, you got to. Come on, bro.
25% on a baseball bat.
Come on, bro.
That's tough.
You got to hit somebody in the head with that. Pause.
That's tough. But I will say this: sometimes also it's not a hostile takeover, but it's a long-term takeover. And I think they love to get your opinion on this. One of the greatest long-term takeovers that we've ever seen is Tesla. Nobody really talks about that. Elon Musk was not the original founder of Tesla. He came in as an investor, and then strategically over the course of time increased his influence, increased his shares, had gained influence with the board, and became the CEO. I think there was actually even lawsuits of the original founders of Tesla after the whole thing was done. But Elon Musk took over Tesla.
Yeah.
So talk about that too, because that happens sometimes too, where you can actually get in on a ground level as an investor and have a long-term plan to strategically take over something, and then before you know it, I guarantee you, not one person knows the original founders of Tesla.
Yeah, you never hear about them. Their name's not on any car. They're not memorialized in any way. And he did that, but he came in with a lot of money too. He was part of the PayPal mafia, part of that group with Reid Hoffman and others that built PayPal. Really built a lot of the early parts of Internet 1.0 and 2.0. So he did come in with a sizable percentage, but he did accumulate assets over time. It was sort of a creeping takeover, not necessarily hostile, but he was accumulating shares along the way, much in the way that, you might find even the Carl Icahns of the world did, but Carl was trying to take over companies to literally take them over and then break them apart and sell them. In the case of Elon, he was so he could take over the company and craft it in his vision. And his vision for the company, we're seeing it right now, was not necessarily the cars. It was always the batteries first, right? Yeah. Batteries first, and that could turn into cars. But now we're seeing what he really wants to do with it, which is robotics and agentic AI. And he thinks that's the future, and driverless cars. That's the future of the company. But it was a slow takeover. It took a number of years for him to finally accumulate enough shares and then enough influence among the board and among outside investors to eventually take over the company. I can't remember what year it was, but he did that. And then he eventually took it public famously on the NASDAQ. Also became one of the greatest stocks of the past 20 years.
Yeah.
When we talk about this takeover, I mean, we just have to look to recent history if we want to see how the future is going to play itself out. Yes, it does take time if Netflix does get approved. But we said this about 5 years ago when Disney purchased Fox Searchlight. And we thought that was the biggest, and it is, right? To this day, like that was the biggest transaction unless this gets approved. What are some of those similarities that you saw inside of that merger, right? Because it feels like it's not just one monopoly that's happening. Like Disney has its leg, right? When it took over Fox Searchlight, if Netflix gets this, you'll have those two. You'll have Amazon Prime. You'll have Apple TV or Apple Plus. And then everybody else kind of has to just figure out what they're going to do or figure out how they're going to be acquired. But how is the scenario looking for streaming going forward from your perspective?
Yeah, well, just take a look at Disney's share price since that happened. It's a disaster, right? It's one of the greatest companies in history, but it's a terrible stock. It's a terrible stock because it overreached, right? Plus, it had the pandemic, and the pandemic hurt its parks business immeasurably. But the streaming business did come on pretty strong. It tried to be too many things at the same time, and it was too asset heavy. The thing about Netflix is what it is, and pretty much what it has always been, absent the mailing you a DVD in the red envelope. What has it become? It has become the dominant content streaming company that also is one of the biggest producers of content. A lot of people don't know how much they spend every year. They spend like $20 billion producing content and licensing content and accumulating this massive library. So it never strayed, and it's never planning to stray from its mission, except it might stray into sports and some live entertainment, as we've seen. So because it's more of a pure play, I think it has a a much better future in acquiring this enormous library of assets than a Disney did, because it was just another acquisition for Disney at the time, a big one, but it didn't end up paying off. And that library is not as valuable as the Warner library, as the Warner library. So in a way, because it's more of a pure play, I think it's got a brighter future than a Disney might have done it. And again, you can't be saddled with all of these heavy assets that are vulnerable to downturns in the economy, right? So if it's just entertainment, I think it's probably a win-win, but it's going to take time, again, for that stock to appreciate in the way that it has over the past 10 and 20 years.
Two-parter for you. Is there a third party that you think will make a bid to outbid the current group? And a year from now, do you think Google and YouTube outpaces Netflix and Paramount, regardless of who acquires this asset?
Well, I think YouTube, is in pole position. Netflix may have the best streaming service and the biggest subscriber base, but YouTube is the biggest advertising delivery mechanism on the planet with the biggest audience worldwide. We see everything that they're getting into, from streaming terrific shows like this to, building the Shorts library, to every possible manifestation of producing content. So I think it's really a race between those two. Amazon could play in this mix, but I don't think that would be a good use of shareholder money. And I think Amazon knows that too. Its future is in the cloud and in Amazon Web Services, and the other businesses are nice, but I don't think that it comes in as a potential competitor. And look what's happening across the media landscape right now. NBC and NBC News and Versa splitting those assets out right now. The CBS deal into Skydance that tells you where that's going. And then there's a ton of private equity money that is into the production of content and into the AI production and delivery of content. So I think the horse race between Netflix on the one hand for pure entertainment, YouTube for everything else.
Okay, so let's talk about some other economic factors. The jobs report was canceled for the first time in American history. So what does this say? That amongst other things, but what does it say about the state of the economy? And what's your thoughts on where we're headed in 2026?
Yeah, the fact that we haven't gotten the government jobs data, that is troubling for business journalists like me on the one hand, but we're getting so much data anyway. We get great stuff from ADP every month on the private payrolls. I think that tells you a lot more than the BLS survey of households and businesses, when they're literally calling tens of thousands of them on the phone and emailing and saying, are you hiring? How many people are you hiring? Are you planning to hire in the next 3 months? They do that in the first 2 weeks of every single month. So by the time you get it anyway, it's already 3 weeks late. And it's based on an extrapolation of all those phone calls and emails. So I never thought it was that exact. And it was getting muddier by the second, given everything that was going on in the Labor Department with the Trump administration. So the economy, I think, is in better shape than people think, and certainly than the way people feel. People feel terrible about the economy right now. Consumer confidence, guys, as you know, is almost as low as it was during the great financial crisis. And we're in much better shape than we were back then. Just people feel terrible because inflation, they feel like it's going to come even more in 2026, especially in the form of higher healthcare payments and healthcare premiums. They feel like prices have gotten out of control and nobody can control it. So they blame the government and they blame corporations for that. But in reality, if the unemployment rate really is somewhere between 4.4 and 5%, that's still relatively low right now. Wages have been increasing like 3.5% to 4%. That's decent. We are hearing a growing drumbeat about more layoffs, and the AI fears about it taking people's jobs. Those are significant, and just that psychology can weigh in on people. But we continue to spend because that's what we're really good at as consumers. And as long as we're doing that, and you have all these multi-trillion-dollar companies pledging to spend tens, hundreds of billions of dollars with each other, that's driving the other part of the economy. Economic growth is going to be there. Economic growth is going to be there with lower interest rates next year. And we're going to hear that on Wednesday when the Fed comes out with its decision, which will probably lower rates by a quarter point. But it'll signal through the dot plot. It's sort of summary of where Fed governors think interest rates should be a year from now, that they're going to be probably a full percentage point lower 1 year from now. So this combination of lower interest rates and the economy not falling off a cliff, and tariffs being more smoke than fire really at this point in time, and corporate profits are growing. All these things signal the fact that the economy is probably going to grow and might be actually okay, although people on the low end of things are not going to feel it, and they never do. They're just going to feel worse as the investing class does even better.
I saw you on your skateboard today talking about the Fed dot plot. I appreciate that content.
Right.
So there was a report today over the weekend where they were talking about the Mag 7 and how it's had this amazing run. And at some point, the reality check is going to happen. And some analysts are saying it'll happen in 2026.
Yep.
Those same analysts are saying that the S&P is going to have a great year next year. I find it kind of hard to figure out, though, how the two things are going to work, right? If the Mag 7, you're talking about some of the biggest companies, these big hyperscalers, I think they make up 35 to 36% of the S&P. So if those don't do well, how do we see with the rest of the S&P picking up that lift and saying, all right, we'll carry the market from here? What are your thoughts on this?
Yeah, great question. And you guys know this well. If you look at the S&P 500 versus the equal weight S&P 500, remember the S&P 500 is market weighted. The biggest stocks weigh the most and account for the biggest part of the index, like NVIDIA, Microsoft, Meta, Amazon, Apple, you name it. But if you just take it equal weight, it is underperforming the S&P 500 by a fair amount, by about 10% this year. But what we've seen lately, guys, which is I find very interesting, after that 5% pullback a few weeks ago, which seems like forever ago now, the market rebounded almost to where it was. We're about 1% away from all-time highs. And in that rebound, we saw what the technical analysis like to call breadth thrusts. Sounds like a fencing term, but what it really is a majority of stocks rallying at the same time, right? And that's what you want to see in a healthy bull market. You want to see a lot of stocks rallying, not just 10 stocks, 20 stocks rallying to make the market make new highs. And that's really what it was with all these big mega cap tech stocks and AI stocks. Now you're seeing better breadth. And you're seeing better breadth in sectors that actually matter. You're starting to see a little bit in commodities because interest rates are cooling out a little bit on the short term. You're starting to see it in healthcare, which we haven't seen in a long time. You're starting to see it in financials because lower rates are coming. That's going to be good for them in terms of their net interest margins. So you're seeing broader participation in the market. And that's a healthy sign of a bull market in its fourth year. And this bull's getting a little bit tired. That said, we're going into a midterm election year. Those are always a little volatile, but the trend is up and to the right, especially with lower interest rates on the horizon. That powers small to mid cap stocks and sectors outside of mega cap tech. That's actually good news for momentum. I'm not saying we're going to get another 18, 19% year. Probably we'll get a normal year unless something terrible happens.
To follow up on Troy's question, do you think we have a reformulation of the Mag 7? Well, do you think it'll be a consolidation into 5, or do you think they'll keep the Mag 7 and just change the weighting and the structure of it?
I think just by the nature of investor preference, it'll change. As you know, you've seen investors, especially big investors like Berkshire Hathaway and others, pulling bigger stocks like Apple. But the leadership is still the leadership and the biggest stocks in the index right now. So Mag 7, I think that was Kramer who came up with that term along with Fang to come up with a name for that. It's really been, as you guys know, more like a dozen stocks, and you named a few that were a real part of the rally, the Oracles of the world, the Salesforces of the world. They were a big part of that rally as well. Anybody that was tied to the AI build out and has a big market cap was useful and helpful in bringing the market to record highs 18 times already so far this year. But you'll get a broadening out of participation. You're seeing stocks making record highs. You're seeing the banks start to roll back into record highs. The JP Morgans and Goldmans, those were dancing on record highs. So when you see financials doing well and you start to see other sectors rallying along with it outside of tech, that's a good sign. So you'll always have leadership, but we'll come up with a new name in the next year or two for whatever next group of stocks outperforms the rest of them.
Yeah, we got to figure out how to get Broadcom and TSM inside there.
Yeah, Broadcom has been an outstanding stock.
Yeah.
Also, Walmart too. Can I do a follow up real quick, Rashad? The stock is valued at 40 times earnings. I think the stock is up 25% this year. Why do you think Walmart doesn't get the same respect that Amazon may receive, even though if you look going back to 2018, it was priced at $28.10. It's currently at $113.56. Yeah. Despite classification of where they land, why do you think that they aren't put in that Mag 7 or Elite 8 type of range?
Well, did you notice what just happened in the last couple of weeks? What happened with Walmart? What exchange did it move to? It moved to the NASDAQ.
Great point.
Right? It's been on the New York Stock Exchange forever.
Yeah.
Right. And it decided that it needed to be listed on a different exchange, the NASDAQ. Now, why the NASDAQ? Right. That's where the fastest growth stocks in the world live. That's where growth stocks. That's it. That's where you list. And so it wanted to be included in those conversations. So you're not the only one that noticed it, and they noticed it themselves. They are much more than the biggest retailer in the world. And they are that. But they are a logistics company, right? They are a data company, right? That is what they're into these days. And I was just out in Bentonville for the first time. If you guys haven't been out there, first of all, we should go out there and do a Market Mondays out there. There is nothing. It is outstanding. It blew my mind being in that town. And you see the history of Walmart, which is really the history of America, and just all over the place, and the infrastructure that's around the Walmart supercenters there. It's phenomenal. So it wants to be a tech company. It wants to be thought of as a growth company. And so it changed where it was listed. And maybe it'll get that respect because now you got to include it in the QQQs of the world, right? You got to include it with growth stocks indexes, and portfolio managers that own those sectors are going to have to buy it if they don't own it already. And it's actually outperformed. I was checking this out. It's outperformed the NASDAQ over the past 5 years. So it definitely belongs in that exchange, and maybe it'll get the respect that it deserves.
What opportunities do you see in 2026?
Well, I think the sector rotation is helpful and good. We have all been piled into the same group of stocks forever, and it's been great. It's been very rewarding for shareholders, right? If you picked the 5, 10 fastest growing stocks in the market, especially in tech, especially in internet and communications and AI, you have had an incredible run. As a shareholder, no surprise that we have more 401k millionaires than any time in history. We've all been piled into the same stocks. But when everyone's piled into that side of the boat, you can see what happens. We saw, the NVIDIAs of the world, the Oracles of the world, the Microsofts, the Metas, these were down beyond correction territory. They're almost down in bear market territory. So you've had a healthy valuation resizing there, which is good. But in a lot of ways, they've become value stocks or safety stocks, right? It's either gold or that, right? And it all depends on the equity risk premium for investors right now. So I think you're going to see a rotation into a little bit more defensive, but also a little bit more